What if I told you that putting $100,000 into a single stock could either be the smartest move I've ever made or the biggest financial regret of my career? Not years ago, not during some market boom. I'm talking right now, in this economy, with all the uncertainty, noise, and hype. See, I've made mistakes before. I've chased the hot trends, bought high, panicked when it dropped. That version of me, the one that listened more to headlines than to fundamentals and why I lost money. But more importantly, I lost confidence. I promised myself I'd never invest like that again. So this time, I did something different. I built a strategy, I ran the numbers, I looked at the boring stuff no one likes to talk about. Margins, valuation multiples, long-term trends. And when all the dust settled, one stock kept rising to the top, over and over again. It's not a meme stock. It's not sexy. It's not going viral on TikTok. But it is something far more powerful. A business model that prints cash, reinvents industries, and is quietly undervalued right now, even after climbing over 50%. This video isn't financial advice, but it is a window into the exact thinking, research, and framework I used to confidently commit $100,000 of my own money into this one play. So if you're tired of the guessing game, tired of the noise, and you want to understand how real investing decisions are made, then keep watching. Because this isn't about the stock. It's about freedom versus fear, strategy versus chaos, and what it really means to take control of your financial future, one bet at a time. Let's dive in. All right, here's where most investors unknowingly go wrong. Most people don't actually invest. They react. They hear a stock is hot, they read a viral tweet, they watch someone scream on YouTube about 10x gains, and suddenly they're in. No plan, no purpose, just hope. That's not investing. That's gambling with better branding. Here's what most people don't realize. It's not about picking the stock. It's about picking your strategy. Because if you don't know where you're going, any stock will look like the right vehicle. Let me give you an example. If you're 25 and want to grow your wealth aggressively over 30 years, your approach should look different than someone 45 who values stability and income. But guess what? Most people invest the same way in both cases, blindly. So before I ever put $1 into the stock, before I even considered the name, I asked one question. Does this fit the investor I'm trying to become? That mindset shift? It's everything. It turns chaos into clarity. Because now the stocks in my portfolio aren't random. They're aligned. They represent me. That's why this $100,000 move isn't about FOMO. It's about fit. And now I'll show you exactly what I mean. Let me show you why this company checks all my boxes. The stock I'm investing $100,000 into, Amazon. Now, before you roll your eyes and say, yeah, Mark, we've all heard of Amazon. Understand this. I'm not buying it because it's a household name. I'm buying it because most people don't actually understand what Amazon really is anymore. Everyone thinks Amazon is just an online shopping giant, but e-commerce is just one lane. What I'm seeing, and what most investors overlook, is a diversified machine. A company quietly dominating across multiple high-growth, high-margin sectors. This isn't about betting on people buying more stuff online. This is about recognizing that while other companies rely on one or two products to survive, Amazon has four: e-commerce, AWS, advertising, and third-party seller services, each strong enough to be a billion-dollar business on its own. But it gets better, because the real reason I'm bullish isn't just the growth, it's the operational efficiency. Amazon isn't just expanding. It's becoming more profitable with every step, and in a world where efficiency is king and capital is expensive, that changes everything. So while others are sleeping on Amazon's boring 6% year-to-date gain, I'm looking at the bigger picture and seeing a setup that's too good to ignore. Here's what most people completely miss about Amazon. Let's cut through the noise. When most people talk about Amazon, they point to Prime, 2-day shipping, or that they just bought toilet paper with one click. That's surface-level thinking. The real engine driving Amazon isn't what gets delivered to your door. It's what's running in the background. I'm talking about AWS and advertising, two segments that are transforming Amazon from a retail giant into a tech and media juggernaut. Let's start with AWS, Amazon Web Services. It's the backbone of the internet. Streaming platforms, startups, Fortune 500s, they all run on AWS. What's wild is how efficient it's become. Pre-pandemic, AWS had a 26% operating margin. Today, it's over 37%. That's not just growth, that's growth with discipline. Higher margins mean more profit. More profit means more fuel for innovation, buybacks, or expansion, all of which benefit long-term investors. Then there's advertising, the quiet monster. Amazon doesn't just show you products anymore. It's now the third largest digital ad player in the world, behind only Meta and Alphabet. And unlike those two, Amazon's ads aren't just eyeballed, they're tied directly to purchases. That makes them more valuable and measurable, which is why ad dollars keep flooding in. Most people don't realize this, but Amazon's ad revenue is actually growing faster than Meta or Alphabet's, and it's a high-margin business. Every new dollar here drops more profit to the bottom line. Put simply, Amazon isn't just selling more stuff, it's getting smarter, leaner, and richer while doing it. This one stat made everything click for me. Okay, let's get into the numbers, because this is where things get interesting. Right now, Amazon is trading at a forward price-to-earnings ratio of about 34. On the surface, that might not scream undervalued, but here's the thing. The 5-year average? Closer to 39. So we're already looking at a discount relative to its own history, but it goes deeper. Let's talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a cleaner way to see the raw earning power of a company. And Amazon's EBITDA is at record highs. The business is generating more cash than ever before, yet the stock price isn't keeping up. That brings us to a powerful metric, EV/EBITDA, enterprise value to EBITDA. It's like the price tag for buying the whole business compared to its cash-generating ability. Amazon's current forward EV/EBITDA, just 14.1x. That's not only below its 5-year average of 16.5x, it's one of the lowest levels in over a decade. Let that sink in. A company growing revenue, expanding margins, dominating high-margin segments, and yet being valued cheaper than its own historical average. This isn't hype. It's a mismatch between what Amazon is doing and what the market is pricing in. That's the kind of setup I look for. That's when I press the gas. Now here's the smart move I'm making instead of buying straight up. Now here's where things get interesting. Most people hear I'm putting $100,000 into Amazon and assume I just bought a ton of shares at market price. But I didn't. Because great investors don't just ask what to buy, they ask how to buy it. Amazon's trading around $235 right now. I could buy in at that price, but I'd rather get paid to wait for a better one. So instead of chasing, I'm selling put options. Specifically, $200 strike price puts expiring in November 2025. Here's the play. I collect $215 per contract today, which goes straight into my account as income. I sold 5 contracts. That's over $1,000 in instant cash. In return, I'm agreeing to buy 500 shares of Amazon at $200 each. If it dips to that level, that's my ideal entry. And if it never gets there, I keep the money anyway. Now this isn't for beginners. Options come with real risk, and I'm prepared to back this with $100,000 in buying power if assigned. But that's the point. I want to own the stock at that price. This isn't about being clever. It's about being disciplined. I'm not chasing highs. I'm creating opportunities on my terms. That's how you buy stocks like a business owner, not a speculator. Now let's get real about what this investment actually represents. Look, putting $100,000 into a single stock sounds bold, maybe even reckless. But when it's backed by a strategy, real research, and clear math, it becomes something else entirely. Intentional. This isn't a YOLO trade. This is me putting my money where my conviction is. And the reason I can sleep at night isn't because I think Amazon will moon tomorrow. It's because I know what I'm buying. A business with real cash flow, proven leadership, and multiple engines of growth. That's the difference between freedom and fear in investing. Fear trades on noise. Freedom trades on knowledge. And if you're wondering what this $100,000 really represents, it's not just capital. It's a decade of learning, mistakes made, lessons earned, a personal reminder that real wealth is built with patience, not panic. So now I want to hear from you. So let me flip the script for a second. If you had $100,000 to invest in just one stock, what would it be? Drop it in the comments. Let's have a real conversation down there. Not hype, not guesses, but strategy. And if you found this breakdown helpful, if it gave you even one idea to think differently about investing, do me a quick favor. Hit that like button. It takes 1 second and helps this reach more people who are trying to build real financial freedom. Subscribe if you haven't already. I drop deep dive content like this regularly. And if you want to follow my option trades in real time, including the $100,000 Amazon strategy, check out the Options Edge program linked below. No fluff, just real moves from real investors. Thanks for being here. I'm Mark, this is Dividend Hustle, and I'll see you in the next one.